Well, for the next 6 to 9 months, we have to get some sort of resolution on both Brexit as well as the U.S.-China trade situation. So that risk is not going away. It's very well known, and a lot of our hedge fund managers feel that some of that risk, that global growth slowdown impact, is priced into some of the markets out there. Probably some of the risks that we're discussing internally involve, will consumer spending slow in the U.S.? The U.S. Consumer has really been driving the equity markets and earnings growth. If that were to slow, you could see the U.S. stall a little bit in terms of equity markets. And yet there's another upside risk, and that is European earnings growth might be improving in the next 6, 9, 12 months. So there's the potential for the current risks to remain in place, Brexit, U.S.-China trade. We are monitoring the U.S. consumer to make sure that they don't pull back from generating growth there. And we're monitoring another theme, that a risk of missing the upside, especially the sector rotation and the upside of improvement in the European equity markets. That's something our hedge fund managers are talking quite a lot about. Well, one thing that we're very proud of on the portfolio team is that we're quite dynamic in moving the portfolio around. If the market cycle changes, we will adjust the portfolio. If our view of the market risk profile changes, we'll add to the risk overlay. And we currently are discussing 2, maybe 3 portfolio shifts in the coming months. Of the 4 strategy buckets, so we've got equity long short, relative value, macro CTA, and the event driven, we're talking about possibly adding to relative value, adding to a manager that can capture some nice performance on the downside in bond markets if bond prices were to come under pressure. So we're talking about adding to relative value, and we're talking about trimming a bit from macro CTA and equity long short. They've had very good performance. In some cases, the managers are outperforming the S&P on an outright basis. So we may trim equity long short, trim macro, and add to relative value. Yeah, so amazing, huh? 17 trillion of negative yielding fixed income. I believe that was a few weeks ago. Given the sell-off, it's closer to maybe 14.5, 15 trillion, but this is a huge number. So what is a retiree supposed to do to generate performance with not much risk? The hedge strategies, what they're doing is, yes, historically they would benefit from increased interest rates. Okay, that's not the case right now. If anything, they're low to negative. But they are finding alpha, they are finding performance through fairly substantial sector rotation that is going to probably continue for the next 3 to 6 months. Not only sector rotation in Europe, as we mentioned in an earlier question, but the U.S. is setting up for some fairly sizable sector rotation, where the underloved sectors, energy, materials, industrials, not quite yet financials, they need a bit more time, but some of the lagging sectors, energy, industrials, and materials, they actually are seeing a big improvement in earnings growth. So they may be some of the outperformers. Some of our hedge fund managers are buying those underloved sectors that have an earnings growth catalyst, and they're taking profits in technology, in healthcare, and hedging out general market risk with equity index futures. But the U.S. sector rotation, in the absence of higher rates, which creates alpha, thank goodness they're finding alpha through sector rotation. As we mentioned in a prior question, we're quite dynamic in moving the fund around. We've got the 14 managers, we've got the 4 different strategy buckets, we've got the risk overlay, and the portfolio team, the 3 of us, we meet at least twice a week, if not more. Earlier this year, we did trim a bit from a technology-focused manager in equity long short. We thought they might see some more volatility. That's proven to be a sort of a neutral impact on the portfolio. We have implemented, this is important, we have implemented a approximately 13% risk overlay hedge on the portfolio. We are short US S&P 500 index futures and NASDAQ 100 equity index futures. We think that the markets could be a bit more volatile for the coming weeks, and we want to dampen that volatility. So that's a large impact change that we've done to the portfolio. We did lower relative value earlier in the year. We increased macro earlier in the year. Now we're going to maybe take some profits in macro and add back to relative value. So in short, we've made some strategy moves, we've made some manager moves, and we've changed the risk profile using the risk overlay. We've been quite active this year in the fund. In the past, we actually feel that the next 6 months we're going to have to be quite dynamic as well.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。